Shot session. Shot session.
What would be, to go off of, what would be a couple reasons or main reasons why someone would be more inclined to get life insurance?
Because number one, if you have a family that you leave behind, that's the easiest way to make them millionaires or thousandaires. Okay. Number two, adding on to that, so I'll say 1A and 1B. The lifestyle that you live or the lifestyle that you want to leave behind for your family in the event of your absence is pivotal, because we see a lot of times what happens if you and the wife bought a house, or me and my wife, we buy a house, but we're not covered for life insurance. Well, you have 5 kids and I have 4 kids. If something happens to us, guess what? Now, what happens to that house? What happens to the kids' future? Do they have to decrease their chances of going to school and have to work? All these different variables that come into that. And then third, there are now options where you can utilize it. I know people like the term of be your own bank, but I have to use that carefully.
Right.
But there are ways where your money can actually accumulate over time and you have access to borrow or withdraw that money while you're living and still not affect the death benefit of what's to be benefited from your beneficiaries.
Okay, because I've seen those situations. I've heard. Let me just say that where now, I don't know if I'm using the right term, where you're allowed to basically, like how you said, not be your own bank, but take money out from your life insurance and maybe do something to the house or vacation or take care of a bill or something like that to that situation. How would that work out? Is it after the first premium, or like a couple premiums that they have to pay, or a couple years would that be, or it's all a base?
That's a great question. Ideally, what I tell my clients is wait after 2 years, 24 months. If you don't like how 2 years sounds, 24 months. And it also depends on how aggressive they want to overfund the policy. So for an example, let's say you have a policy where you pay $70 a month and it covers you for $200,000, right? Well, that $70,000, that's $70 per month is your obligation, meaning you have to pay that, right?
Right.
Let's say you get a raise at work, taxes come back, birthday money, extra money from a different job, whatever, and you say, you know what, I want to put more money into the cash value portion of my life insurance.
Okay.
That's building interest. You have every right to do that. That's not obligation. That's an option. So you can take an extra, let's say an extra $200 per month for the next 24 months. That's what, $4,800 that you just put into there, contributed. Well, you got to think that $4,800 is building at a specific interest rate based upon the policy that you have. So in 2 years, you're still going to have $4,800 based off of your own doing. Right. But that interest that's accumulated on top of that 48 could give you anywhere between, let's say, $7,200 total and more, depending on how it performs.
Okay.
So you just made interest off of your $4,800 that you've contributed yourself.
And that's all right. So with the let's just go with the 200. Is it for the 2 years that you're doing the 200, or is it just like how you say, you just keep on going?
It's for life.
For life.
So for that regard, that's considered to be part of an index universal life policy.
Okay.
And so the index universal life policy is a variation of whole life, meaning it covers you until you pass away. It does not have a termination date. Okay. So as you are continuing to live, you can be 90 years old and you can see the illustration based upon your projected totals. We go through that. You can have specific amounts of money in there. If you want to grow it, if you say, hey, in 5 years, I want to have $40,000 saved up in here. Well, that's where I, as the broker, would go through different illustrations to show you exactly how you can get $40,000, $50,000 saved up into your IUL policy that's building cash value.
And just for the sake of clarity, right? You're you're putting your money, investing into the insurance policy, and that's accumulating the profit from there, and then after a certain amount of time, you generate, and then you're able to pick and pull.
Shot session. Shot session.